Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We are on a number of different stations and the 8 major podcasts. They call them the Big 8. Daryl, do you have those the Big 8 names there for me?
Yes, lion, elephant, rhino. Oh, no, that's different.
That's a different big rhino. That's Republican in name only. Elephant is the Democratic Party. So I'm getting them right.
Yeah, donkey. There's a donkey in there, too.
There's a donkey in there? Exactly. Yeah, the Big 8 podcasts.
It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Okay, all of these are available. And if you go to any of them, as well as our YouTube channel, which is Jeff Barton, the Mortgage Voice on YouTube, you can click that you like us or that you want to be alerted when a new program comes out. Any of that really gets us in front of more people. And the object of our show is to educate and inform, not sell. So you can feel pretty trusted that we're going to be the go-to people when you need information about mortgages, about rates, about different programs from different lenders. We have on the show a number of different account executives. We go into appraisals, we go into credit repairs, we go into all kinds of things with the sole purpose of educating, making sure that you guys, you gals out there who want a mortgage can get one with confidence that you know what you're doing. Because obviously most people do this once in their life, maybe twice in their life. And so it's a foreign thing. It's like if you want to buy a car, you go into a car shop or a car dealership and you really don't have any idea what you're buying. I don't. And I know something about cars, but you're never quite sure. And you always have that feeling that you're being sold something. Well, that's not what the show is about. And we certainly want you, when you're asking the questions to the mortgage professional that you're dealing with, have some idea when they start to give you the talk or the explanation. And most real estate professionals are very good at this. They'll sit you down, they'll walk through what it is that you're trying to do, or ask you questions about what you're trying to do, and then give you some options that will help you, find your way through the entire mess, which is the mortgage industry. Let's face it, there's thousands of lenders. Let's say there's 1,000 people out there who offer you a mortgage. Well, that's a lot of people to research. So normally what happens is you find a trusted somebody who gives you a recommendation to somebody else. Well, would you buy health insurance like that? Well, maybe you do buy health insurance like that. I always recommend give it a little time. Find out what's happening in the marketplace. Find out who the best in your area or somebody that you can trust, because it's really important to get the best possible information when you're out there shopping around. Let's go through a few things right off the top of the show. The mortgage interest rates this week. We've seen mortgage interest rates pretty much the same for the last 6 weeks. There's a reason for that. It's a little bit longer, but we've seen this trading range for bonds and mortgage-backed securities in a very narrow space. So when I say that, we know that treasuries are what drives mortgage interest rates. So if you have a buyer buying everything on the market, you're not going to get a fluctuation in prices. Therefore, the mortgage interest rates are going to be the same. And so we've talked about this before, and we'll continue to talk about it. One of the topics during the show will be what's going to happen next year, right? Everybody wants to always know what's going to happen next year. Who's going to be elected? Where are we going to go? What's real estate price going to be? And all of that I can address a little bit based on what I've read in a few articles. And one main article that came out in Housing Wire, and there's a lot of great sources and a lot of good articles out there as to what's coming down the pike. And this isn't pie in the sky stuff. These are pretty straightforward. And the interest rates, because of where they are, because we have Fed buying mortgage-backed securities, $40 billion a month, buying treasuries, $80 billion a month. Well, that really solidifies the market as to, regardless of what the demand is, that's going to be the purchase. So therefore, trading range for both those bonds and consequently the mortgage interest rates are very narrow. So you get 2.98% the 30-year, 2.61 for the 15, 2.36 for FHA, and 3.35 for jumbo loans. And those have really been the story of the last 6-8 weeks. Because in deciding early on during COVID, the market needed liquidity. Now, what does that mean? It needs money in order to fund things. Well, the Fed stepped up right at the beginning and said, this is what we're going to do. It's kind of like what they used to call the quantitative easing. These are names that are just annoying, right? To the average person, what does that mean? It means nothing. What it meant was simply that the Fed, this is the quasi-government, non-government entity which controls the monetary policy in the United States of America. They sell bonds through the Treasury. They lend money to banks, member banks, who then again lend it out to other banks, which is really how it goes. So the bonds themselves, the mortgage-backed securities, which are bought and sold by the Fed, but they've been buying, as I say, a total between mortgage-backed securities and treasuries at about $120 billion a month, and they're going to take on an additional, trillion and a half dollars worth of debt this year. Their particular balance sheet is now tipping $5 trillion. Another tidbit of fact: the gross domestic product, that's the total sum of all goods and services produced in the United States, will be eclipsed this year by the debt, the national debt. So if you're saying, what do we got, a $13 trillion GDP? Is that what it is? So we're going to eclipse that in terms of what we owe each and every year. So we're getting into very strange economic times. Now, I'm not an economist, so I can't tell you whether debt is a good thing or a bad thing, or whether you can afford it, or what percentage of the incurring debt is of the gross domestic product versus, the continuing spiraling out of control costs of the unfunded mandates of Social Security and Medicare and Medi-Cal. I just went on Medicare, so keep funding that, or the Social Security benefits, which I haven't yet to collect, but will be in the next 4 or 5 years. And many millions of Americans depend on all this. So is driving the debt up by funneling money through the Fed to purchase mortgage-backed securities and the bonds, is that a good thing long-term for U.S. and the people that collect and depend on those kind of things? And can we continue to drive the debt up without consequence? When we know that the money we make and take in is going to be less than we are actually borrowing that year, i.e. the number I quoted, the gross domestic product, we tend to rely upon, or used to rely upon, to make it very clear that the U.S. economy is in great shape and that we can really withstand anything. And that's the power of freedom in the United States. These things are big questions, right? Things that get answered in major elections or major social programs or lack of social programs or funding of the Defense Department, and all of the things that money gets spent on are the big decisions that affect all of us individually. So when we're talking about mortgage interest rates, all of these things are factored in to the rate itself. So if we in turn tomorrow are, have another 9/11, we're going to see rates interrupted. If we in turn see that we're in a major recession, i.e. another COVID, rates are going to be affected. But for the most part, we've been in a very narrow range the past 6 to 8 weeks, and will be, my prediction, for the rest of the year, regardless who wins the election. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Okay, thank you very much for tuning in. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much again, as I said, and this is the Mortgage Voice. You can hear us on a number of different podcasts, the Big 8 podcasts they call them. We're also on 5 different radio stations in 3 different states. From Albuquerque, New Mexico, all the way up to Lake Tahoe, Nevada. We're in Southern California in the Inland Empire, San Bernardino, Riverside counties. We touch a little LA, a little Orange County as well. And we're also in Las Vegas, Nevada. All of these markets are really booming. And I've got to say that some of the markets boom at a lower voltage or wattage than others. But let's go through a couple of these home prices in different areas, just to give you an idea out there of what's happening in different areas in the marketplace. Okay. In Albuquerque, New Mexico, where we are our newest affiliate down there. What are the call letters down there, Carl?
It's K-Mine country, K-M-I-N and K-M-M-N. It's K-Mine.
Excellent, very good. No, we're very excited to be down there, and we're always looking for more information, and some realtors and loan officers and people in the trades to come on the show and talk to you about what's happening in their community. But they're so busy, they haven't been able to actually get in touch with me. We do have a couple of people to come on the show. Anyway, Albuquerque, the sales price for median home in Albuquerque, New Mexico, $249,000. And that's up 13.1% year over year. Those are big numbers. You see a rise in real estate prices of 13%. We haven't seen those since 2003, 4, and 5. And we saw that routinely. We used to get very close to that on a monthly in some areas. That's excellent. It speaks well to the area and the desirability of living there. We have sales in 17 days or less, and usually it's three offers on average per property. That's great in terms of what's happening in that particular market. Now, what's happening in the building, what's happening in resales, what's happening in the mortgage market is all wrapped up in these figures. So we can say across the board, real estate is doing great. I talked to a couple of realtors who tell me that sales have really never been better, although there aren't enough product, and that is universal. In any market we're talking about, there is not enough product. There, since 2008, have been a lack of product nationally. But since COVID, a lot of people just stopped the building entirely. So we are really in need of more building. Now, we have a strong builder sentiment. The builder sentiment index that comes out once every quarter. So San Bernardino Riverside, the median home price there is $400,664. Now, San Bernardino Riverside, it wasn't 4 or 5 years ago that most of the properties in San Bernardino Riverside came out from being underwater from the last recession. So this number is a big number. Let's up in Lake Tahoe, 476,000. Now, what I understand from Eisner, as well as Dan Woodworth, who are a couple of our correspondent realtors and loan officers who live up in that area, they tell me that there is in many different cities in the U.S., a great exit. And that exit has ended up here. And it has driven in Truckee and some of these other areas, the price of real estate sky high. So to say $476,078, hey, come on, that's $500,000 on a median home price. That's a big number. And of course, up in Las Vegas, $330,000 is the median home price. And again, here we have, in 2010, I was going to buy a condo in Vegas for $25,000. Think about that for a second. This is not that long ago. This is 9 years ago. $25,000 after the last recession, where prices there just bottomed and cratered, and home builders went out of business, and many people lost their homes. But that particular condo at $21,000 today is worth over $150,000. Think about that for a second. In 9 years. Well, it just goes to show you, with lack of property and the economy was booming, there was huge demand. Even with 11 to 12 million people still out of work from COVID. You are having such high demand that the prices in Vegas and all of these areas continues to climb, anywhere from 3 to 5% up to, what did I say, 11, 13% in Albuquerque. Those are big numbers and big rises. And so if you're out there and you're thinking, wow, what's going to happen next year? Next year, we've got a little bit different story in what's going to happen according to experts. But again, what do the experts know? We don't know currently today at the airing of the show who's going to win the election or what state taxes will be in, who is going to be promised what, if we're going to get a federal mandate for universal health care. A lot of things that could change the dynamic of the financial situation in your home, the country, in an area, has yet to be determined, yet to be decided. So all of these areas, which boast tremendous price growth, still needs housing to be built. And housing to be built is based on the large home builders, and the large home builders are going to want to make sure that when they start building, the structure that they're going to be gauged against tax-wise is the same as when they sell a house, and that won't be known until after first of the year. So really, for the next 3-4 months, we're going to see a rise in home prices. We're going to see the availability of home prices, homes in general, shrink, and we're going to see mortgage interest rates stay the same. The good thing is that mortgage interest rates have never been lower. Now, I don't know how many times last year I've said this, but I continue to say it. They have never been lower. I think at the end of this year, we're going to see a lot of things change. We're obviously going to have a vaccine on the market, which will give people hope. Hope is a good thing. It will also relieve tension, allow people to be able to make some long-term commitments. Employers will come back to the market. People who are in the restaurant, entertainment, movie theater, anybody who's in a large gathering business, concerts, I mean, you think of all the different sporting events, all the different things that you haven't been able to do this year. There's going to be a lot of people wanting to get out there and do this. And a year from now, I even look even sooner. Let's say March or April of next year, you're going to see a great portion of the country really going about their business. And that's going to affect not only the availability of housing, it's going to affect the home builders wanting to build more. It's going to affect the rates. There's going to be more demand on money. I think the rates will go up just simply as a result of that. We'll get into that in the next segment. So if you're out there and there's an opportunity to buy something now, it's a good time. If you can afford the monthly payment, it's a good time. If you can look at the down payment in a purchase and see that it is probably something that you can afford, it's a good time to buy. All of these things are indications to buy now. We're in the real estate business. Look, we're going to make money in every market. We always do. Why? Because there's always supply and demand. If it's a downturn in the economy, prices will drop. If it's an uptick in the economy, lucky, this downturn in the economy is also met with really low interest rates and low inventory. So the people that are working are still paying top dollar for the house, even though it might be cheaper on a monthly basis. That's the important thing to remember. Each market is different. So as we move forward towards election and then post-election to the January market, understand now's a good time to buy. There may be opportunity then. I'm not quite sure because of lack of inventory. And I think all of those things make things a little bit unsure, I guess is what I'm saying. But I am sure right now it is a good time. A couple other things just quickly in the marketplace itself. We talked a little bit about Quicken is changing its name to Rocket Mortgage. Just wanted to reiterate that. So if you're out there and you say, hey, what happened to Quicken Loans? Just know that Rocket Mortgage has since they're going to use that as their name, and they're going to and they have sold on the New York Stock Exchange. I think it's the New York Stock Exchange. I'm not quite sure. It could be NASDAQ too. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email
Welcome
Jeff
back, everybody.
Barton
I'm
at
Jeff Barton, your voice in the mortgage industry. Thanks very
info@malibufunding.net.
much for
Now, back to
listening
the
each and
Mortgage
every week.
Voice
We're on
with your
a
host,
number of different
Jeff
radio
Barton.
stations from Vegas to Albuquerque up to Lake Tahoe, as well as the Inland Empire in San Bernardino and Riverside counties. We touch LA and Orange County as well in Southern California. Jeff Barton, the Mortgage Voice, is on YouTube, so if you go there, click that you like this show. It helps other people find us. More people need this information. It's a very interesting time. We've seen rates really pretty much stay the same for the last 6 to 8 weeks, probably will through the end of the year. There's a lot of reasons for that we've already touched on in the show. One of the people that I always go to for local information in Southern California, as well as great information on loan programs in general, is Connie Hernandez. She's a broker for PMA. Connie, thanks for coming to the show. How are you doing?
I'm doing great, Jeff. Thank you for asking. How are you?
No, I'm tired. Let me just tell you this. We're all tired in the mortgage business because at the pace we're running. And some of the infrastructure is fraying at the seams over here at Malibu. We're still doing well in servicing our customer, but it's a hard time just because people get worn out. How are you doing?
Well, I mean, I'll be quite honest. It is a little bit exhausting having to deal with the multiple changes that are going on. Especially now we're, approaching those target dates for Fannie Freddie, additional hits on our files. So I'm sure most of us are scrambling, trying to lock as many loans as we can for our customers. But we definitely have more files in hands right now. I'll definitely agree to that.
Okay, also, the programs that people are most interested in are what? Conventional, FHA, specialty programs? What are you seeing?
Well, I'm still seeing a volume of people buying, even though as I'm sure as well as I know, the FHA guidelines have been changed quite a bit individually by different investors, different lenders that we work with are adding overlays on what normally would not be an issue. FICO score of, let's say, 620. Now, if you're purchasing, you have to have lower debt ratios in order to qualify. There's just a lot of changes that are going on with FHA files, but I still have quite a few files where borrowers are purchasing with a lower down payment. They have the income, they have the credit scores, but they are definitely looking at not putting a lot of money into their properties and on the initial purchase. Where, it's been different before. I think the interest rates are probably an indication of that. The rates are really low, so why put 20% down? They're saving their money, and possibly could be because of what we're going through with this whole COVID situation. People are a little more cautious about how much money they're depleting from their savings.
No, that's an interesting point. There's two sides to that, right? I mean, obviously, if you can keep more money, you don't mind paying a little bit of a premium on an FHA loan. Is that what you're talking about, something like that?
That's pretty accurate. That's what I'm seeing in
Right.
the San Gabriel and Inland Empire area. At least that's what I'm seeing in the last 3 to 4 months.
Now, I've seen that the median home price in your area, and you're in Covina, I believe, which is kind of on the border of all those different areas. The median home price is almost $500,000. That's
It is.
that's,
It
that's
is. It's
right.
difficult to find a 12 to 1,400 square foot home in the Covina or surrounding areas under 500. More than likely, it's really pushing more the 600 mark.
Is that sustainable? Is the population there able to, obviously they're able to afford it, but can you say that looking at how prices have increased over the last 4 or 5 years, can we see that we may be approaching Orange County or LA County prices?
I think so. I mean, I definitely don't see, a large inventory. I'm sure that's also affecting the prices. And most of the agents that I'm working right now are still competing for properties. You know, I have one agent that, if I had to tell you how many offers he submitted for one couple and trying to get them into a home, it's a crazy amount. Just a crazy amount of offers that have gone out there. And buyers are getting multiple offers, and buyers are also, sellers are getting multiple offers. Buyers are submitting offers over asking price. Right now I have 3 clients that are pre-qualified that are working with 2 agents that I've worked with for many years, and I've seen it many times where they're offering $10,000 above asking, and they're still not getting the property. So I think the interest rates obviously have a big role to play with that, but at the same time, you kind of have to wonder how much longer will that happen.
I agree with that. I was saying earlier on the show down in Albuquerque, New Mexico, which is a completely different market, still has the same demand. I think it's 3 offers for every sale. And so if that kind of demand is the way it is, I wonder, with limited inventory, like you just said, how long prices can keep rising, and the trade-off between lower down payment and higher prices, meaning that instead of the loan getting 20% down, the loan's going to get 3.5% down, but the seller is going to get the extra money. So is that, I don't know, man. I get so mixed up as to what is better for the economy, what's better for the market. Nobody wants to see a repeat of what happened in the last recession. I don't know. What are your thoughts on that?
Well, you know, we've been around long enough. I've been doing this I think a little over 28 years now. And we've gone through the highs and lows several times. And we know the rubber band can only expand so far, right? So.
Right. No, that's right. I mean, you're going to have a give and take. The question of most buyers, and because most buyers, most sellers do it once, they do it twice. So to maximize or minimize whatever you're trying to do, losses or your gains, is like the only thing you care about. We because we deal in thousands of loans over the years, we look at the larger picture and say, okay, what's really best here in this situation is to try to, lessen this or increase this. But the pressure on the deals, especially when it comes to selling a property and then a buyer buying the property, I mean, we're in a huge seller's market still, even with 11 million people out of work. It's stunning to me.
Well, listing agents definitely don't have to do much to sell their properties today, right? Because, the demand is just so high. And again, we're talking about low inventory. But I don't know if maybe once we get past this COVID, people will be more open to putting their homes on the market. If that's the case, then obviously will happen. Obviously the prices will start going maybe back to a little bit more of a normal, not as much competition, but most definitely I believe that once people are more comfortable with people viewing their homes, and obviously more people are more comfortable showing their homes, that's going to make a big difference.
Yeah, I agree. I think increased inventory is obviously the way to go. Increased interest rates will slow down the buyer demand, which obviously will equal the number of buyers to sellers, which will soften the price somewhat. I think all of these things are in play after the election and next year. Connie, I'm down to my last minute. Could you tell people how to get in touch with you if they need a terrific loan officer in Southern California?
Well, thank you, Jeff, again. We're located in downtown Covina, and we're happy to answer anybody's questions. We're happy to pre-qualify you or walk you through the many questions you may have on what's going on in today's market. We can be reached at area code 626-918-2419 or direct to me, 626-422-2017. Thank you for having me, Jeff.
Thanks, Connie, very much. Let's catch up tomorrow. Thanks very much. I'm Jeff Barton, your voice for the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, and thanks very much for listening each and every week. We're on 5 radio stations, 3 different states, from Albuquerque to Las Vegas, in the Inland Empire, in Southern California, as well as up in Tahoe. A lot of great areas. If you do go to YouTube, Jeff Barton, the Mortgage Voice, click on You Like the Show. Why? Because it helps other people find us, and it really is a good service that we're trying to provide by giving you information that you don't necessarily have. We're also on the 8 major podcasts. They call them the Big 8. Carl, you have those names for me?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, radio.com, and of course the biggie, YouTube.
Excellent. Thank you very much. We are timely in terms of trying to get to you the information about what's going on right now, right today. We are pre-election, and we are, I guess, I don't know whether we're post, we're mid, whatever we are, COVID. We're seeing a lot of different things happening within the economy, and I'm not quite sure whether that's related to what's going on with COVID, but we're still seeing a great number of layoffs. As Carol just said, 28,000 people getting laid off at Disneyland. That can't be a good thing. With us right now, however, to give us some information about what's going on in the Inland Empire is George Gonzalez, Malibu Funding. George, how are you?
Hey, I'm doing great over here, Jeff. Just enjoying this heat, the last minute heat. How about yourself?
Okay, I'm fine, thank you. You know, usually with that heat comes fires. I don't want to see that this year. I want to see the fires other places. Now, we had a little bit of a scare, but it seems to have calmed down now. Tell us what's going on in the mortgage industry. What's happening out there in your neck of the woods?
Oh, man, that's just buried. You know, there's so much
Yep.
business out here between refinances and between purchases going on, and you know, banks keeping up with the volume. This adverse market fee coming up. It's
annoying.
crazy, Jeff. It's, you know, it's a madhouse on the buying market. So I have so many pre-approved buyers just
Yep.
house hunting and searching and putting offers and just not getting no love, no accepted offers. So they're getting, you know, a little frustrated and impatient.
Yeah, I think that's true all over. There's a lack of inventory. Now, do you think the lack of inventory is because there's no housing being built, or there's no housing on the market because they don't want people in their homes?
Correct. And you know, and that's what I'm seeing mostly, because, you know, a lot of realtors that I know who I work with are telling me, you know, that they're kind of slow on their buying side because, you know, no offers, not getting no love on their offers. And
Right.
and I'm like, wow, I know it's hard because I'm seeing overbids, even 10, 15, 20,000, with sellers making buyers sign appraisal contingencies that if the appraisal comes in 20 grand lower, that they'll come out of their pocket the difference, you know, not caring. And that's when it's getting out of hand, I believe.
Well, you know, it's interesting. You say that that's built in the contract. How does a lender look at that when they see that, okay, if appraisal doesn't come in, they're willing to come out of pocket for that? Doesn't the lender look at that as if, you know?
Well, you know, obviously, you know already the appraised value, that's all the bank's going to loan off based off of the appraised value. So every addition of a dollar that's the sales price they put the offer with is coming on top of what's already been, you know, in the numbers of closing. It's just an addition of whatever the overage is.
How does the lender look at it, George, when they're saying, look, we want let's say for this particular borrower, we want 10% down, but they've got to put 5% more because the appraisal didn't come in, and they've got to match whatever that is. Let's say it's $5,000. Does the lender look at that $5,000 as equity in the house? Or based on the appraised value, is it still 10%?
No. They look at it as basically money in the air because it's over
Right.
the appraised value.
Right, exactly. So that money becomes money that is not used towards the loan, nor is it used towards the equity in the house. So really you're, like you say, money in the air. That's a good way to look at it, because I don't even know how you classify it.
And that's what I've been telling all my buyers. Like, you know, I know you guys want to buy. I know tired of renting. I understand all that. But right now there's so many new builders building right now. So the inventory is picking up. So I'm hoping, I'm thinking that as soon as these new builders bring up these new homes, that'll relax the buying market a little bit and kind of calm it down, and then there'll be more, inventory for our buyers. So I'm telling them, just, try, don't overdo it. Basically, don't overexert yourself, when you don't need to.
Yeah, is it KB? Is it Pulte? Is it Shea Homes? What are the builders out there?
Lennar,
Or is it
Lennar, KB?
Lennar?
All the new builders are all building, like on the out, and over here on our side. I don't know how it is over there in your area, but over here in the Inland Empire area, they're like on the outside areas, the desert. A lot of them going up the hill in Victorville and,
Right.
up in that area. And then they got Moreno Valley, Riverside, where they're doing a lot of new buildings.
Yeah,
New
and,
houses.
and what is the, I guess, the approachable point? What are the sales price for those type of new homes, and what size houses are there?
Sales price, let's say an average 2,100 square feet, living square
Okay.
feet on a 5,000 square foot lot. Is, so let's say that's average.
Okay.
And you're looking on the outside skirts anywhere brand new, 400, 4 to 450-ish, or 380 to 450-ish,
Wow, that's a
depending on
good
what
number.
you do. If you had any upgrades or whatnot.
Well, that's a big number. And what kind of loan would you give on a property like this? Are most of those loans done in-house? How does that work?
Well, the loan right now, the good news is, the loan limit for FHA at 3.5% down is at 442. So,
Okay.
they're kind of almost in that range. But if not, most people can come in with 5% if they have a decent, 700 score or something like that. For 5% down on a conventional, you'll get a better payment than an FHA payment.
And you're seeing that the borrowers in your sphere, the people that you represent, trying to buy a new house, their credit scores are above 700, and they can come in with 5%. Or is this across the board?
Yeah,
Even with
and I'm noticing that, Jeff. I'm noticing, probably over the last year or so, people have actually worked on their credit. I'm noticing all these buyers or borrowers have been getting prepared probably for a couple of years, with the market the way it was. And so they fixed their credit, and round two, is what they call it, round two, because the round one is done and they're back up, ready to go again, if they lost their first house, back in the good old days.
Yeah, well, it's funny you say that, because there's been a lot of talk about inflation in real estate prices because of the lack of inventory, even with, 11, 12 million people still out of work. And as I said, Disney laid off 28,000. So your idea, your prognostication of what's going to happen in the next 3 or 4 months, either pre or post-election, I think that the sentiment in the country is going to change drastically if we get change in administration. I don't know how that helps or hurts certain buyers and sellers. What do you think lies ahead for us?
Well, all I know is I've been just paying attention to these Feds, the meetings that they're doing, and they're saying that they're not going to raise the interest rates on their end until 2023, which me and you've been doing this business longer than I have, and can tell you just from the little bit of knowledge I have, I'm telling you that they don't always tell the truth. So I'm thinking 2021, 22, they want to hit you off guard when they're going to raise their prices. So
Yeah, I think
they
that's
don't
true.
ever give you the exact date. They say, oh, maybe this date, that date, but it all comes down to how the data looks, how our market is doing.
I agree, and I think that employment is the number one thing. And how is that employment in the Inland Empire for most people? It's a very working class group of people. There are a lot of high-end homes, but a lot of people are working. Both people in the family. If it's a two-person family, they're all working. What are you seeing?
Well, a lot of them are working virtually from home, and
Right.
thank God now for all this savvy technology that anybody can work from home, and most people up in our area, it's not much labor work. It's a lot more of technical work and stuff you can do online, and so
Right.
out here, it seems I'm from Ranch Cucamonga area, so it seems pretty fair out here, but a lot of ugliness went to the lower jobs, the day-to-day getting paid, daily dollar pays, or restaurants and, smaller businesses in that range are the ones who are feeling this effect right now, is what I believe.
Okay, excellent. Hey, George, shout out your phone number for people or a way to get in contact with someone who's a terrific loan officer out in your area, Inland Empire of Southern California.
Direct cell phone number is 909-900-9565. And
Excellent.
once again, 909-900-9565. George Gonzalez.
Thank you very much, George. This is George Gonzalez from Malibu Funding. George, thanks for coming on the show once again. Great information. Thank you.
Thanks for having me, Jeff.
Sure, absolutely. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hey, welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening to the show each and every week. We're on a number of different radio stations in a bunch of different places. YouTube, if you go there, Jeff Barton, the mortgage voice. And of course, we're on the Big 8 podcasts, and those Big 8 podcasts really send our message to anybody who wants to hear it. And Daryl, you got a list of those Big 8 for us, please?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Okay, so why are rates going to go up next year? Why are things going to change next year? This isn't pie in the sky prognostication, but it is a pretty informed view as to what is happening now and what's going to change in 2021. Obviously, we've got an election. Obviously, that's going to change. But in terms of the actual specifics, let's get into it. There are 5 or 6 things I want to talk about right now that are going to impact the mortgage market. And it's going to impact it negatively, i.e., interest rates are going to go up. Maybe that's a good thing. And why do I say that's a good thing? It's not a good thing for you individually as one person trying to get the best deal possible. But for the country, for the market, for buyers to be able to not have to put in 20 offers to get anything close to an accepted offer, have more of an equal buyer-seller market. That's good for everybody because it allows people to be able to get into the market who wouldn't necessarily have a right to. Now, if you've listened to the show all day today, you know that the competition is fierce in our listening area for properties, whether it's Albuquerque or Las Vegas, whether it's Southern California or up in the Lake Tahoe, Mid-California region. It is hard to find a property out there in the marketplace that you can put an offer in, negotiate it, and get a sale. There's a lot of competition and a lot of people out there trying to do the exact same thing at the exact same time. So what are these 5 or 6 things? Okay, 5 reasons rates will rise in 2021. Number 1, 2020 is going to be the second highest mortgage origination ever. $3 trillion. Think about $3 trillion in mortgage originations this year. Only eclipsed by one other year, that was in 2003. So that's not going to happen again. For average year, last year, 2019, was $1.5 trillion. So we've doubled the number of mortgages. That's why we think mortgage rates will go up, because we're not going to have this long, lower interest rates forever. And the housing inventory is going to increase. So therefore, if we just have the mortgage marketplace go from $3 trillion to $2.5 trillion, rates will probably rise. And that's the reason that you're going to have less mortgages. Number 2, the end of the mortgage-backed security purchase after 2020. Now, what we've talked about many times, the Fed is putting its what they call their toe or their thumb on the scale. And the reason they're doing that is to maintain money in the system for loans, money in the system for businesses. That is really what's kept the housing market strong, and that the housing market will lead us out of the current recession. So will that continue? Will the Fed continue to buy mortgage-backed securities after 2020? Most people say no, they're not going to do that. The Fed itself doesn't like quantitative easing, which is what happened after the 2008 mortgage crisis, and they don't like it now. They don't want to buy mortgage-backed securities, and they don't want to buy treasuries. As we said earlier in the show, they're buying mortgage-backed securities to the tune of $400 billion, I'm sorry, it's 400 a year, $40 billion a month, about $400 billion a year, $500 billion, let's say. That's a big number, and they don't want to do that anymore. And if they don't do that, that means that interest rates will rise. Number three, debt, 100% of GDP, 198% of GDP by 2050. We cannot rely upon the economists to tell us it's okay to continue to borrow more than we make forever. It can't happen. And as a result, people are going to want to get paid more now rather than rely upon some later. Interest rates will rise as a result of that. So the debt is going to weigh heavily in the mortgage market. And that's another prediction that I think is going to happen. And by the way, these aren't my predictions. An article I read on the Housing Wire, very good article. If you get Housing Wire, read it each and every day, and you'll become more educated than most of your peers out there. Certainly as a buyer, these are macro issues. But they really affect what your interest rate is going to be when you want to buy that, 2-bedroom house, 1,250 square feet out in the middle of nowhere, USA. That's what we're talking about in terms of qualifications for mortgages. That's also one of the risk factors. And I wanted to talk a little bit about that now. Okay, so GSEs. GSEs are Fannie Mae, Freddie Mac, and Ginnie Mae, government-sponsored enterprises. Now, after the 2008 mortgage crisis, let's call it that, the government stepped in and bailed out Fannie and Freddie. Right? I think it was $168 billion they dumped in. As a result of that, they took ownership and conservatorship, meaning they ran the company. They told them what to do. And an office called the Federal Housing Finance Agency was created. I named Mark Calabria is currently running FHFA. He's the guy that's instituting the policy of what they call the adverse market fee, which is 50 basis points added as a fee on your loan. The reason he's doing that is so that he can fund the pool of money needed by the GSEs, Fannie Mae and Freddie Mac, in order to release them from conservatorship. They have to have a pile of money in order to backstop bad times. That pile of money is, I think it's 1%, something thereabouts. And so in order to do that, we've now instituted this fee, 50 basis points on each and every loan. When the GSEs, Fannie and Freddie, get released from federal conservatorship, the market is going to look at that negatively. You're going to see that as the government, i.e. Fed or the federal government, the Treasury, stepping away from backstopping mortgage-backed securities. Right now, because the federal government, FHFA, are in conservatorship of these two entities, they market views this as the U.S. government guaranteeing the loans. So therefore, in the mortgage-backed security sector, those that aren't being purchased by the Fed, i.e. $40 billion a month, purchased on the open market, a pretty safe bet, because if the mortgages themselves go bad, the federal government's going to step in and guarantee the bondholders. Well, if in fact they get released from conservatorship, Fannie and Freddie, by Mark Calabria, was collecting the fee in the adverse marketing fee, that means that the government is no longer going to backstop those loans. This is what the market sees. Whether it's true or not, I don't know. And I don't think anybody really knows because it has yet to be spelled out. What we have now, because of the change in government possibly, we're having a rush to do this by Mark Calabria, FHFA, guy who runs it. So as a result of all this, we're going to see interest rates rise because risk carries with it the need to protect those who take on the risk. If you're going to risk something, you got to make money in order to be able to do that. So therefore, that's what's going to happen. So I predict, and so does this article, the interest rates in 2021 are going to go up again as also a result of this. And the last one, of course, is the fee that I've just told you about. It's being instituted right now for December 1st. Anything that's got a 45 or a 30-day lock rate, look, if you're in a 45-day lock rate, it's September 29th. So we're almost 30 days away from October, November, right. We're almost 2 weeks away from a 45-day lock and a 60-day lock on anything for December 1st. So 50 basis points is going to raise your interest rate by, they say it's an 8.125. We know interest rates are going to rise as a result of this fee. So you combine all these things together, you're going to see interest rates rise next year. Now, question of whether that's good for the market, I've already asked that question, because when you raise interest rates, every eighth of a point, you cut out 100,000 buyers, something like that. So if you're going to raise the interest rates a half a point, you're going to cut out 500,000 buyers. If you raise it a point, you're going to cut out 1 million buyers. Well, that's a big deal when you're dealing in a macro sense, when you're selling, whatever it is, $5.5 million, 5.5 million homes a year. That's basically a guesstimation. That's about what we're going to sell this year. So if you cut out 100,000, 200,000, 1 million borrowers to be able to buy a home, that's going to level the playing field between buyers and sellers. Now, is that a good thing? If prices remain stable or go down a little bit, buyers get a little bit of an edge. More people at that point can afford a house that's lower priced. The price is going to go up because interest rates are going up. Yes, it's a chess game. And listen to me. For those of you out there who are listening, you understand by listening to the show, these are concerns for every borrower and every buyer out there. Anyway, I'm Jeff Barton. Thanks for listening to the show. We're on LinkedIn and Facebook each and every day as well. We do about a 4 or 5 minute hit on what's happening that particular day. Thanks very much for listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.